December 4th, 2024, Manhattan, New York. The global headquarters of BlackRock, a name that manages $11.5 trillion more wealth than the entire economy of Germany. In a sleek glass tower overlooking Central Park, BlackRock's chief investment strategist Wei Li sat at her desk, reviewing the latest market data. The numbers painted a picture most investors refused to see. American government debt had swollen to $36.56 trillion, roughly 124% of GDP. But that wasn't the troubling part. The troubling part was what happened when she calculated how much compensation investors were demanding to hold long-term U.S. Treasury bonds. The term premium, that extra yield investors require for trusting a government with their money for 10, 20, 30 years, was rising, not gently, sharply, relentlessly. Like a fever that refused to break. That morning, BlackRock published its 2025 investment outlook. Buried in the technical language was a declaration that would send tremors through global markets. BlackRock announced it was going underweight on long-term U.S. Treasuries. In plain English, they were dumping hundreds of billions of dollars in American government debt. But here's what most people missed. This wasn't a sudden decision. This wasn't panic. This was the final public confirmation of a pattern that had been building for 3 years, a pattern that China had recognized first. Between 2022 and 2024, China reduced its U.S. Treasury holdings by $281.3 billion, from $784.3 billion in February 2024 to $730 billion by July, then down to $765.4 billion by March 2025. Japan, the United Kingdom, Brazil, nation after nation quietly backing away from what had been considered the safest asset on Earth. And now, BlackRock, the world's largest asset manager, was telling its clients to do the same. To understand what this means, you need to grasp one uncomfortable truth. When the biggest money manager on the planet starts selling American government debt, it's not making a bet. It's reading a verdict that's already been written. The question isn't whether the United States can sustain its debt. The question is what happens when the rest of the world stops pretending it can. This is not a story about numbers on a spreadsheet. This is a story about power, perception, and the invisible thread that connects an empire's military dominance to its economic credibility. It's a story about how superpowers don't collapse in dramatic explosions. They unravel slowly, bond by bond, creditor by creditor, until one day the world wakes up and realizes the emperor's credit rating has no close. So how did we get here? How did the financial instrument that once symbolized global stability become something even BlackRock won't touch? To understand that, we need to go back 3 years, to the moment China started selling. For 8 decades, U.S. Treasury bonds served as the bedrock of global finance. Governments, corporations, pension funds, everyone held them because everyone believed in one simple promise: the United States would always pay its debts. It was faith backed by the world's largest economy, the world's most powerful military, and the dollar's status as global reserve currency. BlackRock understood this architecture better than anyone. As the largest asset manager on Earth, it had more money invested in U.S. Treasuries than most countries' entire GDP. For decades, the firm advised clients that long-term U.S. government bonds were the ultimate safe haven, the place you parked money during crises, during wars, during financial meltdowns. But something fundamental shifted after the 2008 financial crisis. The United States began borrowing at an unprecedented scale. $10 trillion national debt became $20 trillion, then $30 trillion. By December 2024, it had reached $36.56 trillion. The deficit to GDP ratio, which BlackRock estimated would stay between 5 and 7%, kept climbing higher. Tax cuts, stimulus programs, military spending, infrastructure projects. The bills kept coming, and Washington kept borrowing. Here's where it gets interesting. At the same time, foreign creditors, the nations that had been financing America's debt for generations, started quietly pulling back. China reduced its holdings by $173.2 billion in 2022, $50.8 billion in 2023, $57.3 billion in 2024. Japan trimmed $22 billion in May 2024 alone. Even the United Kingdom, America's closest ally, began rotating out of long-term treasuries. Why? Because they saw the same data BlackRock was now seeing. Government borrowing wasn't slowing down, it was accelerating. The Trump administration's One Big Beautiful Bill Act included massive tax reductions that analysts warned could push deficits even higher. Moody's downgraded the U.S. sovereign credit rating in 2024. Yields on 10-year treasuries climbed 50 basis points in just a few months, reaching 4.4% by early 2025. This set up a dangerous feedback loop. Higher yields meant the U.S. government had to pay more interest on its debt. More interest meant larger deficits. Larger deficits meant more borrowing. More borrowing pushed yields even higher. And BlackRock, watching this spiral, made a calculation. The same calculation China had made 3 years earlier. The United States was entering what economists call a debt sustainability crisis, the moment when creditors begin questioning whether a borrower can ever repay. To understand how this trap was set, we must examine the economic forces at work and the desperate choices America made that led here. The trap was set long before anyone realized they were walking into it. After the 2008 financial crisis, the United States faced an existential problem. Banks were collapsing, the housing market had imploded, unemployment was soaring toward 10%. The Federal Reserve, led by Ben Bernanke, made a radical decision. They would flood the economy with money. Not metaphorically, literally. The Fed began buying U.S. Treasury bonds by the hundreds of billions, a policy called quantitative easing. Between 2008 and 2014, the Federal Reserve purchased over $2 trillion in Treasury securities. The logic seemed sound. By buying government debt, the Fed would push interest rates down, making borrowing cheaper for businesses and consumers. This would stimulate economic growth and prevent a depression. At first, it worked. The economy stabilized, unemployment fell, stock markets recovered. But there was a problem nobody wanted to discuss publicly. The Federal Reserve had become the largest holder of U.S. government debt. Not China, not Japan, not private investors. The American Central Bank was financing the American government by printing money and buying bonds. It was a sophisticated version of what banana republics do when they run out of money, except the dollar's global reserve status meant the world had to accept it. Foreign creditors noticed. China, holding over $1 trillion U.S. treasuries at the time, began asking uncomfortable questions. If the Fed could print money indefinitely to buy government debt, what did that mean for the dollar's value? What did it mean for inflation? What did it mean for anyone holding American bonds? The answer came slowly, then all at once. By 2020, the COVID-19 pandemic struck, and the United States did what it had always done in crises. It borrowed. But this time, the numbers were staggering. Congress approved $5 trillion emergency spending. The Fed expanded its balance sheet by another $3 trillion, buying even more treasuries. National debt exploded from $23 trillion to over $28 trillion in just 2 years. China watched this carefully. Chinese economic strategists understood something American policymakers seem to ignore. Debt is only sustainable if creditors believe it will be repaid. And the more the U.S. government borrowed, the more the Fed printed, the less credible that promise became. In April 2022, China's holdings of U.S. Treasury securities fell below $1 trillion for the first time in over a decade. It wasn't a dramatic announcement. It wasn't retaliation. It was simply mathematics. The risk-reward calculation for holding long-term U.S. government debt had shifted. But there was another problem, one that would prove far more dangerous. In 2022, inflation in the United States reached 9.1%, the highest level in 40 years. The Federal Reserve, which had spent over a decade promising inflation was dead, suddenly had to reverse course. They began raising interest rates aggressively, from near zero to over 5% in less than 2 years. This created a devastating paradox for U.S. Treasury holders. When interest rates rise, the value of existing bonds falls. A 10-year Treasury bond issued in 2020 with a 1.5% yield suddenly looked worthless compared to a new bond paying 4.5%. Investors who had bought U.S. government debt during the low-rate era, pension funds, foreign governments, institutional investors watched their holdings lose value. China accelerated its selling, $173.2 billion in 2022 alone. Japan, despite being America's closest military ally in Asia, trimmed its holdings too. Brazil, Switzerland, Saudi Arabia, creditors who had long viewed U.S. Treasuries as untouchable, began rotating out. But nobody was panicking yet. The conventional wisdom held that this was temporary. Once inflation cooled, the Fed would cut rates, bond prices would recover, and everything would return to normal. BlackRock, however, was running different calculations. In July 2023, the firm published a research note announcing it was going underweight on long-term U.S. Treasuries. The language was technical, cautious. BlackRock maintained it was a tactical position, not a strategic retreat. But the message was clear. Even the world's largest asset manager no longer trusted long-duration U.S. government bonds. The reason BlackRock cited was something called the term premium, the extra yield investors demand for the risk of holding long-term debt. For decades, that premium had been low because U.S. Treasuries were considered virtually risk-free. But starting in 2022, it began rising sharply. Why? Because investors were recalculating the fundamental question: could the United States actually repay its debt? Look at the numbers. By 2024, annual interest payments on the national debt exceeded $1 trillion more than the U.S. spent on defense. The deficit to GDP ratio, which economists generally consider sustainable below 3%, was hovering between 6 and 7%, and every projection showed it getting worse, not better. The Trump administration, returning to power in 2025, proposed sweeping tax cuts that analysts estimated would add trillions more to the debt. The so-called One Big Beautiful Bill Act included provisions that would push deficits even higher precisely when fiscal discipline was most needed. Moody's, the last major credit rating agency still giving the United States a perfect AA rating, downgraded the U.S. sovereign credit rating in 2024. It was a symbolic moment, the financial equivalent of a doctor delivering bad news a patient had been ignoring for years. But here's what made the situation truly dangerous. The United States didn't just need to borrow money to fund current spending. It also needed to roll over existing debt, refinancing trillions of dollars in bonds that were maturing every year. If creditors stopped buying U.S. Treasuries or demanded much higher interest rates, the entire system could spiral out of control. China understood this leverage. Instead of announcing a dump of U.S. Treasuries, which would have triggered accusations of economic warfare, Chinese financial institutions simply stopped buying new bonds and allowed existing holdings to mature without reinvestment. From $784.3 billion in February 2024 to $765.4 billion by March 2025, China quietly backed away. Other nations followed the pattern. Japan increased holdings slightly in some months, then reduced them in others, a deliberate strategy to avoid appearing coordinated while still reducing exposure. The United Kingdom overtook China as the second-largest foreign holder of U.S. debt, not because Britain was buying aggressively, but because China was selling consistently. What they didn't realize was that BlackRock was about to make the trend impossible to ignore. December 4, 2024, BlackRock published its 2025 Global Investment Outlook. The document was 40 pages of carefully hedged language, charts, and economic forecasts. But buried on page 23 was the sentence that would define the year ahead. We are underweight long-term U.S. Treasuries from both a tactical and strategic perspective. Tactical and strategic. That meant BlackRock wasn't making a short-term bet. This was a fundamental reassessment of American creditworthiness. Wei Li, BlackRock's chief investment strategist, explained the logic in a press briefing. U.S. government deficits were structurally high and showed no signs of declining. Inflation remained above the Federal Reserve's 2% target, meaning interest rates would stay elevated. And most critically, the term premium that extra yield investors demanded for long-term risk was rising toward levels not seen since the 1980s. We see this as a return to past norm, said Michelle Dilmanian, a portfolio strategist at BlackRock. But everyone understood what past norms meant, the era before the dollar's unquestioned dominance, when U.S. government debt carried genuine risk. The market reaction was immediate. Yields on 10-year U.S. Treasuries, which had been around 3.9% in early 2024, climbed to 4.4% by March 2025, a 50 basis point jump in just a few months. That might sound small, but in bond markets, such moves represent hundreds of billions of dollars in lost value. Foreign creditors accelerated their exit. China reduced holdings by another $18.9 billion in March 2025, falling from second to third place among foreign holders of U.S. debt. Overnight, when U.S. markets were closed and Asian trading dominated, Treasury yields would spike, a telltale sign that foreign investors were selling. These overnight spikes are more than just market noise, observed Joel Schulman, founder of Entrepreneur Shares. They may be the clearest signal yet that China is quietly but deliberately selling U.S. Treasuries. And that's when everything changed. In April 2025, Treasury yields surged dramatically, the kind of movement that suggested not orderly profit-taking, but genuine panic. Analysts scrambled to explain what was happening. Some blamed technical factors, the unwinding of leveraged trades between cash treasuries and futures. Others pointed to forced selling by hedge funds caught on the wrong side of bets. But the simpler explanation was scarier. Global investors were repricing U.S. credit risk. Think about what this means. For 80 years, U.S. Treasury bonds had been considered the risk-free rate, the baseline against which every other investment was measured. If Treasuries suddenly weren't risk-free, then every pension fund, every insurance company, every sovereign wealth fund holding them had to recalculate their entire portfolio. BlackRock's position became clearer. The firm wasn't just underweight long-term Treasuries, it was rotating into short-duration bonds, European credit, and alternative assets. We have a relative preference for the euro area and Japan over the U.S., Dilmanian stated. Translation: even European government bonds, once considered inferior to American treasuries, now looked more attractive. By January 2026, the pattern was undeniable. Foreign holdings of U.S. Treasury securities had experienced net outflows for multiple consecutive months. Japan remained the largest holder at $1.06 trillion, but even Tokyo was trimming exposure. China had fallen to $759 billion, nearly $200 billion less than its peak holdings. And BlackRock, managing $11.5 trillion in assets, was telling its clients around the world, "We don't trust long-term U.S. government debt anymore. It was not a crisis. Not yet, but it was something perhaps more dangerous, a slow, methodical loss of confidence that, once started, proved nearly impossible to reverse." By mid-2025, the consequences of BlackRock's strategic shift were becoming visible throughout global financial markets. The U.S. government, needing to refinance trillions in maturing debt, found itself paying significantly higher interest rates than it had in over a decade. Every percentage point increase in borrowing costs added tens of billions to annual deficit spending, creating precisely the feedback loop creditors feared. The Federal Reserve faced an impossible choice. If they raised interest rates to combat persistent inflation, they would make government borrowing even more expensive and potentially trigger a recession. If they cut rates to ease fiscal pressure, they risked allowing inflation to accelerate again. Either path led to deteriorating confidence in dollar-denominated assets. Foreign central banks, watching BlackRock's public positioning, accelerated their diversification away from U.S. Treasuries. It wasn't dramatic or coordinated, nothing that could be labeled economic warfare, but the trend was unmistakable. China's holdings fell below $750 billion by late 2025, the lowest level in 15 years. Middle Eastern sovereign wealth funds quietly rotated into gold, infrastructure assets, and regional bonds. American pension funds and insurance companies, many of which had portfolios heavily weighted toward treasuries, suddenly faced uncomfortable questions from their boards. If BlackRock, whose analysis shaped global investment strategy, considered long-term U.S. government bonds too risky, shouldn't other institutions follow? But there was a problem. Not everyone could sell at once. If major institutional investors tried to exit U.S. Treasuries simultaneously, it would crash the market and trigger a financial crisis worse than 2008. So they did what professionals always do in these situations. They sold slowly, quietly, and hoped nobody else would panic first. The tragic irony was that this cautious approach almost guaranteed the outcome everyone feared. Slow, persistent selling put constant upward pressure on yields, which meant constant downward pressure on bond prices, which meant everyone holding treasuries kept losing money. The more orderly the exit, the longer the pain lasted. History offers uncomfortable parallels. In 1956, Britain faced a similar moment during the Suez Crisis. The United States, angry at Britain's military adventure in Egypt, threatened to dump British pound sterling reserves and block International Monetary Fund support. Britain, despite being a military victor on the ground, was forced to withdraw because it couldn't sustain the economic pressure. Within 2 decades, the pound lost its status as a global reserve currency. The difference between Britain in 1956 and America in 2026 is one of scale, not kind. Britain had creditors who could force its hand. The United States, as of early 2026, still benefits from the dollar's reserve currency status, the fact that global trade, oil markets, and central bank reserves are denominated in dollars. This creates what economists call exorbitant privilege, the ability to borrow in your own currency without immediate consequence. But privilege isn't permanent. It's contingent on trust. And trust, once cracked, is extraordinarily difficult to repair. What we're witnessing isn't the collapse of American power. Not yet. It's the slow erosion of the financial architecture that has supported that power since 1945. When BlackRock announced it was underweight U.S. Treasuries, it wasn't predicting a future crisis. It was acknowledging a present reality that most investors were still unwilling to face. China saw it first in 2022, when it began systematically reducing Treasury holdings. Japan saw it by 2024, when it stopped increasing holdings despite being America's closest Asian ally. By December 2024, even BlackRock, whose business model depends on stable, predictable markets, couldn't ignore the evidence anymore. This teaches us that empires don't fall because of military defeats or political upheaval. They fall because creditors stop believing in their promises, and once that belief shatters, no amount of aircraft carriers or diplomatic assurances can restore it. The question for 2026 and beyond isn't whether the United States will default on its debt. Outright default remains extremely unlikely. The question is how much credibility the dollar will lose, how expensive American borrowing will become, and which global power will fill the vacuum when the world's reserve currency becomes just another currency. Today, in financial centers from Shanghai to London to New York, portfolio managers are asking themselves the same question BlackRock asked in December 2024. If the world's largest asset manager won't hold long-term U.S. government debt, why should we? Nobody has a good answer yet, and that silence might be the most revealing signal of all. This concludes the story of how BlackRock dumped $300 billion in U.S. Treasuries and why China saw the signal first. It teaches us that in the architecture of global power, financial credibility matters more than military strength. When creditors lose faith, empires begin their long, slow unraveling, not through war, but through the quiet accumulation of unpayable debts. This pattern repeats whenever nations confuse their ability to borrow with their ability to repay. The only variable is timing. This is the hidden history. Subscribe now because when the next chapter of American decline is written, you'll want to be among the few who saw it coming.